There's a trick the financial world plays on you every single day. And in this explainer, we're going to pull back the curtain and show you exactly how banks, retailers, and yeah, even governments use a weird little quirk in your brain to get you to spend more money. So let me ask you this. You get a $3,000 tax refund. 60 days later, poof, it's gone, right? New TV, maybe a quick vacation, a few nice dinners out. But what if you get a $3,000 raise spread out over the year? You barely even notice it. It just gets absorbed into your life. It's the exact same amount of money. So why do we treat it so differently? Well, I'll tell you this much. It is not an accident. It's by design, and it's called mental accounting. And this gets us to this kind of strange paradox we're going to explore, how our brains can look at the exact same amount of cash and treat it in wildly different ways. See, a dollar from your paycheck just doesn't feel the same as a dollar you get back from the IRS. And understanding why, well, that's the first step to taking back control. So what is this trick really? Well, there's a name for it. It's a cognitive bias called mental accounting, and it was identified by the Nobel Prize-winning economist Richard Thaler. It's basically our brain's weird habit of creating these little mental buckets for our money. We've got our serious money, our fun money, our found money, even though, let's be honest, it's all just money. Think of it like this. Your brain doesn't just see one big pool of cash when it looks at your finances. Nope. Instead, it's keeping these secret, invisible ledgers. The money from your salary? That goes right into the rent and bills ledger. But that $50 you found in an old winter coat? Oh, that goes straight into the treat yourself ledger. And they feel completely, totally different. And this right here gets to the heart of it. Thaler's research showed that we really, really resist moving money between these mental accounts. We would rather rack up high-interest credit card debt than dare to touch the money we've mentally labeled the kids' college fund, even when it makes zero logical sense. That psychological barrier is just that strong. Okay, so here's where it gets a little conspiratorial. This isn't just some funny little quirk of being human. It's a well-understood phenomenon that the entire financial industry actively uses. They literally have a playbook designed to turn your own psychology against you. So let's break down the 4 key plays from this playbook, because once you learn to spot them, I guarantee you will start seeing them everywhere, from how the government talks about money to the price tags at the grocery store. First up, the tax refund frame. You better believe governments know all about mental accounting. They time these refunds perfectly and call them refunds or stimulus to make it feel like a bonus, like free money from the sky. But it's not a bonus. It's your own money. It was an interest-free loan you gave the government. But by framing it as a windfall, they shove it right into your fun money account. And just like that, they stimulate the economy with your cash. Next, we've got the rewards ruse. Oh, credit card points are just brilliant, aren't they? They create a whole new mental account, the reward points account. You get that little dopamine hit from earning points, which cleverly detaches you from the pain of spending the actual dollars. And that makes you way more likely to overspend, all for the joy of getting that free flight. Then there's the old classic, the house money fallacy. Picture this. You go to a casino. You win $100 on your very first bet. So what happens next? You're probably going to make a much riskier bet. Why? Because that $100, it isn't your money anymore. In your head, it's house money. It's in a totally different mental account with a different set of rules, which makes it a whole lot easier to lose. And finally, the one you see every single day, the pricing ploy. Your brain sees a price like $19.99, and it just anchors on the 19. It gets filed away in the teens bucket. But $20, whoa, that's in the 20s bucket. That single penny difference pushes the price into a completely different mental category, making it feel way, way cheaper than it is. It's a simple trick, but it's brutally effective. So, okay, these little mind games, they might seem harmless, but they have a real, tangible, long-term cost. Let's actually quantify it. Let's figure out how this all adds up to a massive blind spot in our financial lives and put a real price tag on falling for these tricks year after year. So let's go back to that tax refund. According to the IRS, the average refund check in 2023 was $2,753. Not a small chunk of change, right? Now, check this out. Research from Thaler himself actually put a number on this. As you can see, we have a tendency to spend windfall money, like that tax refund, at more than double the rate of our regular paycheck. We see it as bonus cash, so it just burns a hole right in our pocket. So here's the question that really matters. If you treat that refund as fun money every single year, what are you actually losing out on? What is the real long-term cost of making that one little mental accounting error over and over again? $135,000. That's what you'd have. That's what you'd have if you just took that average refund check and invested it every year for 20 years at a pretty modest 8% return. By just mentally miscategorizing that one chunk of money, people are potentially missing out on a six-figure sum. That right there is the cost of this blind spot. All right, so that's the problem. But here's the good news. Once you know the trick, you can flip the whole thing on its head. You can use mental accounting not to get played, but to actually win the game. It's time to hack your own mind. Let's walk through 3 simple, real strategies you can use to turn this cognitive bug into a feature that actually works for you. We're talking creating your own buckets, building sinking funds, and doing a little something called the anti-shopping reset. First thing, create your own buckets on your own terms. Set up an automatic transfer from your checking to your investment account for the very same day you get paid. By moving that money before you even really see it, you're mentally recategorizing it. It becomes a bill, just like your rent. It's gone. It's in the untouchable bucket where it can just quietly grow for you. Second, you can actually lean into this desire to categorize. Go ahead and create specific savings accounts for specific goals. A vacation fund, a new car fund, you name it. They're called sinking funds. This satisfies your brain's need to put money into neat little buckets, but it does it with a purpose. It stops the impulsive spending while still letting you save up for the fun stuff. And finally, the anti-shopping reset. The next time you get a windfall, a bonus from work, that tax refund, decide beforehand exactly where it's going to go. Pre-committed. The second it hits your account, move it to pay down some high-interest credit card debt. I promise you, watching that debt number shrink provides a dopamine hit that is way more satisfying than buying another gadget you don't really need. So that's the playbook. Financial systems are basically built to take advantage of these little glitches in our thinking. But now you know the trick. So the only question left is, from now on, whose mental accounts are you going to be managing? Theirs